think we've had a very good run in markets over recent weeks as a result of the vaccine news. So I think it's almost inevitable that at some stage we do get a bit of consolidation. We're getting a little bit of some more negative news on vaccines coming out now than we had in recent weeks. But overall, I think my horizon is looking through the whole of 2021. I think cyclical assets will do well, and within that, equities as the global economy continues to rebound.
I want to get into one of your other calls, this maximum, you've increased a maximum on real estate where you think there's a potential to produce the best returns. I was just noting as I walked through the market open that real estate was one of the areas that has popped, and in particular one of the big shopping centre assets, the owner of Westfield, from my own anecdotal research, having seen the amount of people when they're allowed to go back into shopping centres, there is some pent-up demand. How is that reflected when you weigh up just how beaten up these stocks have been and how much has been bought back at this stage?
Yeah, real estate presents a classic dilemma that the fundamentals were already negative because of changes in the way that we do shopping. We'd seen that over a number of years. So the retail sector was suffering. The pandemic has accelerated that, but also brought into question the demand for office real estate. But on the other hand, that markets reacted to that very quickly. And the yields that are available, for example, on REITs, are now amongst the most attractive that are out there. And if you look across asset classes as a whole, fixed income yields are well below historical norms. Real estate is one of the few assets where yields are above those historical norms. And I think that gives a solid foundation for the asset class. A lot of bad news has been priced in. And that's where I think the good performance comes from. A modest rebound in rentals and dividends, but that yield gives you, I think, a solid anchor.
Very good morning to you, Paul. I'm looking at your various different assets you're looking at, your corporate IG, no advantage over cash, reducing to zero, unattractive government debt as well. Is a lot of this based on economic recovery, or is it based as well on the thought that we may see some form of reflation?
Not so much reflation. I mean, to tell you the truth, if you get a surprising amount of inflation, there are very few assets that protect you in the phase when inflation is going up, or that's what history tells us. And I'm not expecting anything over and above like a normal cyclical recovery in inflation, but it is predicated upon the idea that the global economy continues to recover. We had a very deep recession this year. We've seen a rebound, but we think that there is more to come. And when you're in that recovery and expansion phase of the economy, cyclical assets tend to do well. The other element of this is valuations. The spreads on credit, for example, have normalized very quickly. And so a fair amount of good news is already in the price there.